If you receive unexpected bills after turning 65, you might be throwing away thousands every single year, and you do not even realize it. Picture stepping up to your mailbox on a bright, peaceful morning. You pull open that small metal door and grab a thick stack of envelopes. You already know what is waiting inside before you even tear them open. Medical statements, tax notices, and sometimes collection demand letters. Just staring at that pile can send your blood pressure climbing. It feels like everyone is reaching out, trying to grab a piece of your retirement income. But what if I told you, you might be paying money to parties who have zero legal right to your funds? What if federal and state laws say certain bills belong straight in the shredder? Hold on a second. Let me add important clarity before we get ahead of ourselves. I am not talking about risky loopholes, and I will never advise you to skip mortgage payments or utility bills. Those financial obligations still need to be covered. I am focusing on specific federal and state statutes written specifically to protect aging Americans. The trouble is, billing companies, collection agencies, and administrative departments rely on one major disadvantage. Most seniors do not understand their own legal protections. They count on fear pushing you to write a check and mail it in without asking any questions. Today, we change that. I am breaking down 5 categories of charges and debts seniors are legally excused from paying. By the end of this video, you will understand how to stand firm and guard every dollar you have worked so hard to earn. Welcome back. I am Launa Maiz, and I am so glad you carved out time to join me today. If you are brand new to this channel, pull up a chair, grab your coffee or favorite drink, and let us have an honest conversation. My mission is straightforward. I want to guide you through retirement financial rules without confusing jargon and boring formal lectures. You spent decades working hard. You should not waste your golden years covering unlawful charges. Retirement is meant for peace of mind and enjoyment, and we are going to make sure your money stays exactly where it belongs, inside your pocket. Are you ready to dive in? Let us start with the first bill you should never feel pressured to settle. Let me share the true story of Bob, a regular retired school teacher who dedicated decades to his career. One afternoon, Bob checked his mailbox and discovered correspondence sent from a third-party debt collection firm. Bold text across the letter claimed Bob owed $2,000, stemming from an old credit card and medical debt that fell through the cracks 5 years earlier. The document was filled with intimidating legal language, threatening lawsuits, court appearances, and income garnishment unless payment arrived immediately. A heavy knot formed in Bob's stomach. He survives on a fixed monthly income. The thought of losing a large portion of his check left him overwhelmed with anxiety. He believed he had no choice except to pay, even if cutting grocery expenses became necessary. What Bob did not know, and collectors will never volunteer, federal law shields certain income from private debt collectors. This legal protection falls under the Social Security Act Section 207. It creates what legal professionals call judgment-proof status. This rule is clear and enforceable. Your Social Security payments, VA benefits, and qualified federal pensions are completely off-limits to private collection agencies. They can send endless notices and make frequent calls, yet they cannot legally access your bank account to seize these funds for ordinary consumer debts. That includes credit card balances, personal loans, and leftover hospital charges. The federal government put this protection in place to guarantee your basic survival funds remain secure. There are limited exceptions: overdue federal taxes, student loan obligations, and court-ordered child support. Outside those categories, private collectors cannot touch protected retirement benefits. If the law is this clear, why do agencies keep sending threatening mail and aggressive phone calls? They understand the legislation fully, yet they leverage fear as a powerful tactic. Harsh phone conversations and intimidating wording are designed to scare you into voluntary payments. Collectors lack authority to force your bank to release Social Security money, but they can manipulate nervous seniors into sharing debit card details over the phone. That is the biggest trap you must avoid. Suppose you have an old time-barred debt under your state's statute of limitations. If you send even a small partial payment, as little as $5 to stop harassment, you restart the statute of limitations legally. A tiny payment revives expired debt, and creditors gain the ability to sue you for the full original balance. Now I am sharing 2 simple, actionable steps you can implement right away to shield yourself. First, keep protected federal benefits completely separated from other income inside your banking accounts. If you earn side job wages or rental income, deposit those funds into a separate account entirely. Maintain clean, isolated deposits for Social Security and VA benefits alone. If collectors attempt account freezes, your bank can easily identify every dollar as federally protected income, and the institution is legally obligated to safeguard those funds. Second, whenever aggressive private debt collectors reach out over the phone, pause, stay calm, and recite these exact lines. All my income consists of federally protected benefits. I am judgment-proof. Cease all contact with me via phone and mail moving forward. After speaking, simply end the call. Once you formally demand communication stop, federal law requires collectors to comply. Always remember, you hold the power in this exchange, not the collection agency. Do not allow them to steal your peace of mind or hard-earned savings. Moving on to the second charge, you have no legal requirement to pay. This unfair billing situation happens far more frequently than most realize. Imagine visiting your primary care doctor for a routine checkup or minor procedure. You hand over your Medicare card at the front desk. Staff confirm all services will be fully covered. You head home assuming everything is settled. 2 months later, you open your mailbox and receive an unexpected bill from a hospital or diagnostic lab. They demand payment for random charges, ranging from $50 to $500, labeled deductibles, co-pays, coinsurance, or balance billing. You stare at the paperwork confused, convinced Medicare already covered treatment. The official-looking letter demands full payment within 30 days, or your account will transfer to collections. Most seniors panic at this stage, grab their checkbook and submit payment to evade stress or potential credit damage. Before writing any check, learn about federal regulations protecting millions of older Americans. If you qualify for the Medicare Savings Program classification known as QMB, Qualified Medicare Beneficiary, hospitals, clinics, and providers breaking these rules violate federal law. The QMB program supports fixed-income seniors, covering cost-sharing expenses. Original Medicare does not pay. Rules are unambiguous. Any medical provider accepting Medicare assignment cannot bill QMB enrollees for Part A or Part B deductibles, copays, and coinsurance. Providers must accept Medicare's approved payment amount as settlement in full, regardless of how much your state Medicaid program reimburses the clinic. You bear zero legal responsibility for leftover balances. Thousands of seniors across America receive these unlawful bills each single day. You might wonder, if this practice violates federal rules, why medical facilities keep sending invoices. Intentional theft is rarely the root cause, yet the outcome remains frustrating. In most instances, automated hospital billing systems trigger these notices. Software recognizes Medicare only covers 80% of a claim and automatically generates a bill for the remaining 20% mailed directly to patients. The computer system fails to flag your active QMB eligibility, or administrative teams skip secondary manual reviews. Facilities mail statements operating under the assumption rule-following seniors will pay without questioning charges. Use this straightforward process to halt automated wrongful billing and preserve your cash. Step 1. Verify whether you hold official QMB status. Review your Medicare card, state Medicaid approval paperwork, or call 1-800-Medicare and ask representatives to confirm your enrollment. Once confirmed QMB, you have powerful legal protection. Step 2. Never ignore surprise medical bills and absolutely refrain from paying up front. Dial the billing department number printed on your statement. Speak calmly and firmly using this script. I am a qualified Medicare beneficiary. Under federal law, I am exempt from balance billing and all Medicare cost-sharing charges. Remove this outstanding balance from my account immediately. In nearly all cases, representatives will check internal records, acknowledge system error, and erase the balance completely. Stand firm during these calls and exercise your legal rights. Let us shift focus to healthcare for the third unfair bill. If you are approaching age 65, you likely know that sinking feeling checking mail each day. You get flooded with complicated Medicare paperwork, postcards and insurance guides overwhelming anyone sorting through retirement coverage. Many seniors discover the published premium cost for Medicare Part A, hospital insurance, can reach nearly $500 monthly if purchased fully out of pocket. For anyone managing a tight fixed retirement budget, an extra $500 monthly expense feels devastating. Take a deep breath, because federal law delivers welcome news. The vast majority of United States citizens qualify for premium-free Part A. This exemption operates under what many call the 40 credits rule. Simplified explanation: the Social Security Administration requires 40 work credits to unlock zero-cost Part A coverage. You can earn maximum 4 credits each calendar year, meaning 10 total working years paying Medicare taxes satisfy the requirement. If you worked and contributed Medicare taxes for a decade or longer throughout your career, you pre-funded your hospital insurance decades ago. Upon turning 65 and enrolling, you owe 0 monthly Part A premiums. You might ask what happens for stay-at-home caregivers who never accumulated 40 work credits inside the formal workforce. Do not worry, legislation includes safeguards for you too. You can still receive premium-free Part A based on your spouse's employment record. Requirements include your spouse holding 40 work credits and reaching at least age 62. Another lesser-known provision shocks countless retirees. Even after divorce, if your marriage lasted 10 consecutive years minimum and you remain unmarried, you can claim free Part A eligibility using your former spouse's work history. The system recognizes the vital contributions non-working partners provide families, preventing steep $500 monthly penalties for caregivers. Complete this quick task well before your 65th birthday to confirm eligibility. Visit ssa.gov through your web browser and register for a free My Social Security online account. After logging in, review your official earnings history, which clearly displays accumulated work credits. The whole process takes roughly 10 minutes and delivers tremendous peace of mind. Verify your credits today to lock in your exemption and eliminate that $500 monthly bill from your retirement worries. Onward to number 4, taxes that retirees may not legally owe. Picture this common tax season scenario. You have exited full-time employment and started receiving consistent Social Security deposits. You crafted a balanced monthly budget, fully aware of all incoming and outgoing funds. When tax filing season arrives, you complete your return and realize a significant chunk of your retirement income is lost to state taxation. It feels incredibly unfair, right? Nobody wants to pay taxes twice, especially on benefits the government returns after decades of workforce contributions. It creates frustration when your carefully planned budget takes an unexpected hit from state taxes targeting fixed-income seniors. Thankfully, existing state laws exist to protect your retirement savings. As of the 2026 tax year, most states side with retirees. 42 states plus Washington, D.C., fully exempt Social Security benefits from state income tax. West Virginia recently finalized its full phase-out of Social Security taxation, joining the growing list of retiree-friendly locations. Only 8 states currently impose state income tax on Social Security payments: Colorado, Connecticut, Minnesota, Montana, New Mexico, Rhode Island, Utah, and Vermont. If your state appeared on that list, do not panic immediately. Even within those 8 locations, generous age and income exemptions are written into local tax codes. Middle-income seniors often still qualify for complete exemption. However, a massive pitfall costs taxpayers thousands annually, relying blindly on generic DIY tax software. Automated tax programs operate using broad universal settings and cannot automatically account for every unique resident situation. Residents of Colorado or New Mexico with moderate or lower income frequently qualify for full exemptions, yet online platforms do not always apply these benefits automatically. You may need to manually check specific boxes or file separate state schedules to formally claim your legal exemption. If you rapidly click through software prompts without reviewing details, the system might calculate taxes on your full Social Security amount, forcing you to pay charges you never legally owe. The same risk applies when dropping documents off at busy chain tax preparation offices. Overworked preparers rushing through stacks of files can easily overlook senior state exemptions. Follow these actionable steps immediately to safeguard your money. Retrieve last year's state tax return from your filing records. Locate the line item reporting your Social Security income. Review whether state income tax was charged against those benefits. If you paid tax on Social Security, research your state's official income eligibility thresholds. If your household income falls below legal limits, submit an amended tax return to secure your refund from the state. Remember, the burden falls on you to advocate for your finances. That money covers groceries, utility bills, and gifts for grandchildren. Do not voluntarily hand excess funds over to state government. Double-check past filings and claim exemptions to keep Social Security funds safely inside your own bank account. Our 5th bill covers a fear keeping countless older Americans awake at night. You spent your whole career paying down mortgage debt, finally owning your home free and clear. Decades of memories, family gatherings, and home renovations fill this property, and you believe you are financially secure long-term. Over time, your quiet neighborhood becomes highly desirable, and local home values surge. While rising property prices sound positive on paper, your county property tax bills climb alongside market values. Each new assessment demands larger payments, threatening to price you out of your lifelong home. Surviving on static retirement income makes it impossible to pick up extra work to cover rising taxes. Before you begin packing belongings, learn about powerful legal protections available in nearly every county nationwide for senior homeowners. These safeguards include senior property tax exemptions, assessment freezes, and tax deferrals. Let us clearly define each benefit. A legal senior exemption reduces your home's taxable assessed value, limiting county taxation to only a portion of your property's market worth. An assessment freeze delivers stronger protection. Counties legally lock your home's taxable value starting at age 65, sometimes even earlier. No matter how much neighboring real estate appreciates in future years, your personal tax bill remains capped and cannot increase. A third alternative, known as tax deferral, allows you to delay required tax payments until the home eventually sells, delivering instant monthly cash flow relief. Many states expanded these programs leading into 2026, raising income caps so additional middle-class seniors meet qualification standards for substantial savings. Here is the critical detail almost nobody discloses to you. None of these tax relief programs activate automatically. County assessors will not arrive at your doorstep with birthday reminders to lower your tax burden. Local governments rely on property tax revenue, and will happily continue charging maximum rates each year unless you actively assert your legal rights. Millions of eligible seniors overpay property taxes year after year, purely because they do not realize formal applications must be submitted. Miss your county's annual filing deadline, and you lose tax savings for that full 12-month period, with no option to retroactively claim refunds for missed years. Use these direct instructions to stop overpaying and protect your home. Right after finishing this video, open your web browser and navigate to your local county assessor website. Search your county name alongside Senior Property Tax Exemption. Carefully review published income qualification limits, download application paperwork, gather proof of age and income documentation, and submit your complete forms before the yearly cutoff. This process only requires a small time investment, yet can save you thousands of dollars annually, letting you remain safely in the home you built through hard work. To wrap everything together, successful retirement fundamentally comes down to retaining as much of your earned income as you possibly can. Whether facing pushy debt collectors, automated hospital billing errors, or county tax assessors, always understand one consistent truth. Corporations and government agencies will never volunteer information about available financial relief. They will not knock on your front door to offer discounts. You need to step forward, educate yourself on legal rights, place necessary phone calls, complete required applications, and refuse payment for charges you do not owe. Now I want to hear directly from all of you. Have you ever successfully contested unlawful medical balance billing, or managed to secure a senior property tax freeze through your county office? Share your firsthand experience inside the comment section below, so our whole community can learn and support each other. If this video delivered valuable information for you today, hit the like button, subscribe to follow Launa Maiz, and share this content with friends and family who desperately need to hear these rules. Until next time, plan your retirement wisely.